Thank you for joining iMeet. When you hear the tone, you will be the 22nd person to join the meeting. This meeting is now being recorded.
Check. Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. And not lots going on since our last talk, but we're going to just quickly review the last week or so, see what's going on with our leveraged ETFs, look at some of the market's momentum, and then look at some of the different indexes and see where we think we can go here to finish up the year. This is the first time you've joined us. Generally, we talk about 20, 25 minutes. This may be a little bit shorter because I've got a real bad head cold and about ready to pass out. But anyway, after we talk about 20, 25 minutes, we're going to open it up to some questions on individual stocks or maybe even things we've just talked about during this webinar, and then we'll wrap it up after that. There won't be a webinar next Tuesday. That's we're off on Monday, so probably won't be a lot going on. And then the following Tuesday, on January 2nd, we will have a webinar. And what we're going to do is we'll look at all the different sectors and see what may be overbought, what's oversold, and where we think going into January in 2017, where we think we can make some money. Okay, we're about at the end of 2016, and some of the things I want to touch on. If you were, I had some questions over the weekend about this. If you were in our triple leveraged ETFs based on the CTI, okay, even though the market call went to neutral on Friday, we closed out the ETFs. We don't hold them on there and fudge which way we're going to go. So that gave us from 1021 we went long to 1216. The Dow Jones picked up on that trade. We picked up 1,697.70 points. Like I say, we're neutral right now. We could stay neutral 1 or 2 weeks. And also, one thing to remember, when you have a sell or even a buy, sometimes if the momentum is not there, and some of the other indicators we look at, you could ride through a neutral reading all the way through a sell or a buy period if the market's going in sideways or just turning it sideways like that. But so right now we're still neutral. We'll see where we go by the end of the week here. Okay, as of 12/16 year to date, the Dow Jones has picked up 2418 points. It's up 13.9%. This is the close of Friday, and the CTI picked up 4,374 points, or about 25%. We had a good year with that. Last year, the Dow was down about 2%, and the CTI was up 18%. So it's back on track, and we feel pretty good at this stage. Okay, if you were long with leveraged ETFs, we closed them out 12/16. We made 31% on the Dow, 17.5% on the SPY, 3.4% for the Nasdaq. It's really underperformed, but heck, we picked up 38% on the Russell 2000, which was has outperformed. And this is one of the reasons why I recommend buying all four of these and putting your money evenly. Even though you had a great trade with the Dow, you want to get in here, and some of these things will really outperform each other. And that year-to-date trade, the leverage ETFs, we were up 68.4%, and that also includes every time we go in, include a $16 round-trip commission on that. So if you didn't include that, you're probably up a little bit more than that. All right. First of all, I want to look at. I really don't see a lot of cracks in this market yet, but I do see some. Again, if you were looking for us to go bearish on the market this last Friday, the reason we didn't was because that move wasn't confirmed by the momentum index or the strength indexes, which also show accumulation or distribution in the different indexes. In fact, the strength indexes actually were moved up a little bit last week, even though the momentum index was down a point. But first, I want to take a look at the Dow Jones. You can see we're going a little bit sideways over here. Everyone's sitting here just waiting out to see what's going to happen here if we're going to hit 20,000 or not. If we don't hit it today, we'll probably hit it the next day or two. The move up over here is confirmed by the volume, which has been about double what it was all through here. We're not seeing really any negative divergence in the indicators at this stage, but the MACD short term, which is 12.26.9, MACD is starting to roll over a little bit, and we'll have to wait to see with this. This is the 30-day stochastic, which when I have, to me, was over 80. That means it just shows bullish momentum. So the Dow Jones looks good. We take a step back and look at the Dow Jones weekly. Again, we don't see much problem here. This thing is definitely overbought. You've got the 14-week RSI up here in probably the 90s. With the volume, again, you can see this is confirming the move higher. Again, you're overbought on the MACD, which is an intermediate term trend indicator. Just means the trend is overbought in there. And what I want to look at is when we look at these charts is what's going on with the internal breadth. And here you can see that it's not, this is a leading indicator, the NYSE advanced decline line. And you can see that it may put in a double bottom in here and maybe roll over. That would be something to watch for. But it was able to punch out to a new high over here about 2 weeks ago. And today I think is probably positive too, being up 65 points or so. So that's not showing a crack. I will tell you, we see this as a leading indicator. The best signals are when this thing gets up here and the market peaks, it makes a new high like over here. This thing will have rolled over ahead of time. That negative divergence, you'll always see this peak before the market peaks. So that's something you want to watch for. Here's the NYSE new high and new low. So a great big expansion here a couple weeks ago. This is contracted a little bit. I will say something on this. You have a lot of these ETFs that are leveraged, and also a lot of fixed income bond funds that are in here that made new lows when they came around, raised the rates a little bit. That's why you saw these little spikes. That wasn't tech stocks or biotechs or anything jumping up like that. That was mostly the ETF and maybe some of the prefers and that kind of thing that were bottoming out. Here's the NASDAQ. Again, you can see it hasn't made the move. It's underperformed some of the other indexes. Instead of putting the 50, 200, and 100 in here today, I also included the 21-day moving average because for a rather kind of a shorter term, maybe like a 2 to 3 week, you want to see if this thing's going to hold or stay. You want it to stay above the 21-day, and so far we have that. However, as we're starting to punch out to a new high, okay, the momentum, the 14-day RSI hasn't done anything. It's sitting over here around 60, which is still bullish, but this is the negative divergence. So this is going up, that's going down. That means you're making a new high, but not with the same intensity. You think of that when you throw a ball up in the air. It takes off from your hand, which would be over here. This thing really rocks like that, and the ball's going faster and faster, moving faster, it goes up. But once it gets up to the top, that intensity of the movement has slowed down a lot. And that's what you're seeing here, and that's what the negative divergence is. So when the balls go, you throw the ball up, it's barely moving when it's making a new high before it rolls over. So this is definitely a red flag that we want to see. What's going to develop on that? We go over to the weekly model. Again, you have this negative divergence for a second time. And over here, you also have this MACD, the shorter term, 12.26.9. It's also starting to roll over. It's going sideways, showing there's not much trend in here. And we want to watch that to see if it's going to roll over. And also on these down days, you have some distribution days on some of these big volume days, which is also telling you we're getting a little bit long in the tooth. Okay, here's the internal breadth. Again, this looks much better than the Dow. You came back off a little bit. We'll see if that thing can punch out to some new highs. That's still positive. And you had some big. This is one of the back here. This a couple weeks ago. This is one of the most new highs you had made in the Nasdaq in quite a long time, several years. And again, your new lows are going sideways. So you've had some good expansion. You want to keep this expansion going for the number of new 52-week lows and highs. Now, last year, if you were a member and you were watching this thing, we went to a sell on the market in last November, right after Thanksgiving, and people were wondering why the market was heading up towards their new highs again. And one of the things that we picked up as far as negative divergence, if you remember back then, the FANG stocks were really rolling. And what we saw was when I like to measure the number of stocks that are within 1% of making a new high or a new low. And back last December and stuff, you only had about 6 or 7% of the stocks were making new highs, where you had 25% or so were making new 52-week lows. A big discrepancy in there. It meant that the rally was being supported by fewer and fewer stocks. This go around, it's not so bad. I do see you have about 22% of the stocks within 1% of making a new high, which is fairly bullish. That's down, but although it is down from about 37%, probably just about 2 weeks ago. So even though it's bullish at 22%, the fact that it's dropped from 37% down to 22, it's almost cut in half. That's another red flag that we get a little long in the tooth in here. So keep an eye on that, and maybe I'll mention that if we see that if that dwindles even further by Friday, you'll find in the Friday's market letter that I'll try to point that out, that we're still losing breadth. Okay, I want to compare before we talk a little bit about the market's momentum. Let's look at the S&P 500. Again, you've got that negative divergence here. We're punching up new highs, but the momentum has slowed down as we're moving up, and that's bad. And you also have the MACD ready to flip over bearish. So you're still well above the 21-day moving average. We've talked in the past, about taking your thumb and your first finger and moving to see how far an average moves away from a moving average. Here's the 100-day. If you measure that, maybe measure this, and then you start to measure this, you can see that we're still overbought by that measure. And this still has some room to come down. Take a step back again, look at the weekly. Again, not as bad over here, but you still have some negative divergence, which you want to watch. But as I see these big red days on this thing here, you're getting some big volume on the distribution days, which means after this big spike up here, when you do have a little bit of when they are selling off, you do have a lot. Now, part of this though was option expiration day, so that last Friday, so that's going to account for some of that, and the volume was up, but still, in general, that was a distribution day, which we want to keep an eye on to make sure we don't get more of those. The Dow Jones Transportation Index, again, you've got a little momentum. The momentum's slowing down here, a little bit of negative divergence, and down here the MACD has already gone to a sell. Now you did find support at the 21-day, which is bullish. We're going to keep an eye on that. That looks good, but if this breaks through the 21-day, again, that'll be another red flag. And here's some more distribution days down here that you have some people taking some profits after this big run. Take a look at the weekly. Last week we were down for the week, a big distribution chart. The negative divergence doesn't show up as much in the weekly chart, but I think it will if we have a sideways to down market in transports again this week. Russell 2000, small caps, they've outperformed the Dow and most of the other indexes, but here we're punching out new highs. You're waiting for another leg up. The momentum is slowed. You got a lower high and a lower low on both of these. That's a little bit of trouble. And the MACD also is showing the trend is starting to slip to a little bit negative. So some red flags kind of popping up and all that. And that's, again, telling us that this may be a little bit long in the tooth. And when it's overbought like that, the way the market resolves, it either trades sideways or it comes back. And traders will be watching some of these shorter-term moving averages to see if, when they break support, and that'll be a signal to them that maybe they want to take some profits after this and as they close out of the position. But don't forget also, part of next week, you'll start seeing some tax selling going off in some of these stocks, which can also kind of put a downward pressure on the market. And here's the Russell on the 2000. Okay, you gapped up over here. If this thing comes down and breaks below that gap at 1320, that would be a big red flag. That would mean you're going to come back down here, but I don't expect that. But you never know what's going on. You do have the negative divergence over here. Even with that gap up, the momentum was unable to punch out a new high. So, the red flags are showing on some of these other indexes. And all that's telling you is that you don't sell because you have a negative divergence, but it does mean that you want to be prepared to look at something. All right, one of the things that we do, got somebody in there drawing pictures over here. Jeffrey Innocent. Okay, there we go. All right, what I want to take a look at over here is, I'm not, one of the ways I check momentum, when we do the CTI, we measure the lows or previous highs from the CTI periods. In this case, we have the October. We went to a sell in the market on September 2nd, and we went back to a buy on October 21st. So what we do is we try to find the lows for these different indexes, and off of those lows, the Dow has moved, has gained 10.7%, transports 18.9%. But you look over here, the S&P, the NYSE, the NASDAQ, utility index, and the AD line have all, underperformed the Dow. Okay, that's right. And so when you compare all those different indexes, the Dow was up 10.7%, but if you average out the other indexes and indicators, they were only up 6.9%. And that's why the momentum index is a neutral -1 at this time. When you have the other indexes outperforming the Dow, which we kind of hope we're going to get, you'll see the momentum index punch up to maybe +5, +6, something like that, and that means that the market's going to go a lot higher. Now, this neutral -1 also means that you're a little bit toppy, but again, there just wasn't enough confirmation for us to go to a sell. The neutral call seemed right, and we'll see what happens on this Friday to see whether we go to a sell on that. Now, also remember, we talked last week about the CTI that there still is a possibility that the cycles would have ended the last major go-round on November 7th. We'll know over the next week or two if this thing goes sideways for a couple weeks, then we start up again, and that would probably mean we would rotate the cycle CTI back and begin the wave of the 5 cycles back from November 7th. And if that is the case, the only thing it's going to mean is that we will stay bullish. We'll go back to bullish. We'll stay bullish into probably April. So we could get more of a run, but it's still too early to tell that. It's still too early to say whether we have a top in this thing. So that's, I can hardly talk over here today. That's what I wanted to touch base on today, that we are seeing the cracks in the different indexes. Momentum has slowed. That's not a reason to sell right there. But what it is telling you is that you want to be ready to, if we do start to crack, when you have this fast of a move, this high, that you may want to move the sidelines. Now, if you're still looking to add the positions, or you've added positions, and you're wondering if you should sell some of the things. Now, those that went into the bank stocks we've been talking about, I don't think you want to sell those. Even if we go to a sell in the CTI market, I would probably, you may have some big, you may want to maybe sell some covered calls or something on those, but I would probably buy more financials if the market pulled back in there. That includes the insurance companies, the regional banks. If you don't want to just put yourself in like one bank or two banks, I think you want to overweight that sector. But when you overweight that, you want to go long several different kinds. Like I said, the regional banks, the money centers, the JP Morgans and that. Maybe get into the Goldman Sachs, also these regional banks, FITB, KEY, those are some that they look really good. And you can even go in with some of the regional bank ETFs. KRE is one that's actually up about 28% over the last couple of months. But those are longer term. I think you're gonna still want to be in overweighted the financials. I want to stress that even if no matter what we do on the CTI, you want to hold on to those, and that's probably going to be where you leave. As far as as far as traders go, you want to watch that 52 to 55 area on oil. I'm not sure it's going to be able to crack through that or not, but 52 is our target, and hit 52.50. If it can work its way up past 55, then maybe you can see 60 and higher on oil. That would be bullish for those stocks. But they're getting they're kind of bumping up against resistance here. You're having a little bit more volatility and big swings in some of the smaller oil stocks. usually when you get a lot of, bigger moves at the top, sideways action, but the swings are going, that could be a signal that you're at the top. And then I think, the consumer discretionary sector still looks good. I'm not sure I've been in bed for the last 3 days, but I haven't seen what the retail sales are for the holidays yet. But we're gonna keep an eye on that and see how we can go. But all the stuff with the deregulation of the banks and stuff it means you want to be in there. They haven't done anything for a couple of years now, and this would give you an opportunity to make a good dividend and pick up stuff that historically is cheap. I'm going to go ahead and open it up for a question or two. I don't see any coming in here right now. I hate to cut it short, but I'm having a hard time talking. Okay, I still don't see it. Well, here comes one in. Oh, Merry Christmas. Thank you. Thank you. Merry Christmas to all of you and Happy Holidays. Christmas is coming off. It's come awful fast. I said I do a lot of shopping, so I'll try to beef up those retail sales. And again, we won't have a webinar next Tuesday, but for sure we will on January 2nd, and that'll give us some more. We'll look at all the different indexes and especially the sectors and see where we think we got some more gas. And read the weekly market letter on Friday, just over the next 2 weeks, just to see if the CTI is going to flip to a bearish posture or whether we're going to stay neutral going sideways. All right, everybody. Merry Christmas. Have a nice holiday. Thanks for joining me, and we'll talk to you in 2 weeks.